Hi there traders, and welcome back to the Keyzone Traders Trade of the Week. Another little break, but we are now finished with the summer holidays and we are raring to go into the end of the year. Now, there's been a lot of market volatility in the markets this week, which has created a lot of opportunity for us, and therefore the trade that we're going to look at is a trade that we took yesterday in the DAX, which is going to look at how important risk is, so that even if you get an idea wrong and another opportunity presents itself, you can take that trade as well and still profit from the markets. So with that being said, let's go take a look at the charts. Hi there traders, so welcome back to the Keyzone Traders Trade of the Week. As I said yesterday, we're going to look at a trade that we took yesterday in the DAX. And the bit I want to focus on from yesterday's report that we give in the Keyzone service, which you can sign up for. It's completely free. You get to receive these reports in the morning before the market opens. You can actually also use these reports retrospectively to practice your price action reading skills in the market. So even if you don't trade them directly at the moment, if you sign up to the Keyzone service, you can actually get these reports. You can look at historical data in trading simulators and use these reports to play out real-time information and really practice building up those pattern recognition skills. And it's completely free, so if you haven't already, please sign up to the Keyzone service. You can visit our website, www.keyzonetraders.com. If not, I'll put the link to the Keyzone service in the box below on our YouTube channels and our social media posts. So the bit that I want to focus on, and the bit that is relevant to the trade, we said sustained breaks below 12,705 to 725 can see moves to 12,615 to 635. So now let's go and have a look and see what happened in the action on the DAX yesterday. Okay, so this is the DAX. As you can see, the market opened around here. The market opened here and we had an impulsive sell-off through. We held this zone as a bit of support, but then we got that really big push impulsive through. So we got the sustained break below 12,700 to 725 that we were looking for. Now, when that happens, what we look for is we look for a retest and for it to reverse off the off that zone, and that would be the confirmation of the sustained break. At the moment, we've got the acceptance. The retest of that would put, and then a reversal pattern would say that break is sustained. It's not a false break, it's therefore a sustained break, and we can actually look to get short. So we had this. We come up. So what we're looking for here is either a continuation pattern or a reversal pattern from this area. Continuation pattern looks for a pullback to the moving averages. We've got this pullback here, and you could look to go short on a break of this bar with your stop. You've got two options. You can have either a tight stop with a break just above the bar, and you can target down towards that zone. We said that a sustained break would target 615 to 635. So on this one, you could look for a 2-to-1 risk to reward, which targets literally just at the top of that zone with a tight stop. The other thing that you can do is you could also have a wider stop above here, and that would have produced a 1-to-1 risk to reward. So therefore, that would be, you'd have your stop above the zone, and therefore it would be able to withstand any deeper pullbacks. But obviously your risk to reward decreases. So you want to, if you started gaining acceptance back above that zone, you're stopped out. But acceptance back above that zone would mean that it's not a sustained break, and you have the potential for a false break. So they're your two options. We actually chose to go for that tight stop. We got triggered into the trade, and it was going okay, but then the market reversed and it stopped us out. Now you can see it literally just clipped our stop. This is a danger. This is why you have to decide whether you're going to trade with tight stops or wide stops. We trade with tight stops with small risk, so that when we get stopped out, we lose small amounts, but it gives us the opportunity that if there's another trade that presents itself, we can then re-enter the market. Now, this actually then created another opportunity for us. So we re-entered. The only issue with this one was that the risk to reward was not the best on it because it was such a big bar. You can see it just clipped our stop. We had to have our stop above here, and we just targeted a 1-to-1 risk to reward just above the zone, just to make our profits back, make the profits to regain the loss that we had made on the previous trade. So This trade got entered in, and you can see it quite quickly went down and hit our profit target there to make back the loss before. So on this one, we actually ended up as a break even over the 2 trades. As you can probably see, if you had taken the first trade and gone for the wide stop, you would have made 1R, you would have made 1% on your account if you risk 1% of your account. That's the difference. That's you can't look in hindsight to see whether you should be trading tight stops or wide stops. You need to make that decision yourself, and you need to stick with that consistently. Sometimes it will work out well for you, and you would have made 2% or 2 to 1 risk reward. Other times it's going to work like this, and you're going to be break even. On the flip side, if you go for those wide stops, you're always going to make smaller returns on the trades that actually go and hit your profit target. So there's no right, wrong. It's all about managing your risk. It's all about deciding which way you want to do. And then once you've decided, you have to commit to it, and you have to follow that consistently. We trade majority of the time with tight stops unless there's a legitimate reason in the price action or the market to suggest that we should go for wide stops. But as you can see, in this instance, although we got stopped out, because we use sensible leveraging, we only risk 0.5% to 1% of our account. We're able to then re-enter the market without putting too much capital at risk. If we start risking 2, 4, 5% of our account, if that second trade had lost, we could have been losing 4, 6, or even 10% of our account, which is just crazy on one trading idea. It's not sensible leveraging. It will lead to emotional issues. It will lead to larger drawdown periods. It puts more of your capital at risk. It's just not sensible leveraging to create long-term success in the market. So it's really important to leverage sensibly, therefore to give yourself the opportunity to re-enter the markets when this sort of situation occurs. So that's our trade of the week. I hope you've taken a lot from it. Please let me know what you think in the comments box below. As I say, if you haven't already, please sign up to the Keyzone service. It's got a multitude of value that it can add to your trading, a multitude of purposes that you can use it for. It's completely free to sign up, and the link is in the box below or in the text on our social media posts. So I hope you enjoyed this week's Trade of the Week. Have a great weekend, and I'll speak to you soon.